So impairment is not something that you have to be charging yearly to your profit or loss or your statement of or your financial statement. No, impairment is not something that is on matching concepts. Okay, if you purchase an asset, it means that if the asset will be used for 5 years, it means that after 5 years, the asset will not be there again. So what do? You have to spread the cost over 5 years and charge it against the revenue that you are generating with the one through the usage of the assets. So depreciation is based on the what? On the matching concept. We are using the asset to generate revenue. What portion of the asset have you used to generate that revenue? That's why we charge depreciation. But if you come to impairment loss, loss is not something that we should be doing yearly. No, it's not something that should be charged to profit or loss yearly. We only carry out an impairment test when there is a condition, when there is an indication of that. So impairment is done based on what the prudence concept. The assumption is that we should not be carrying our assets at a value that is higher than we should be recovering or what from the sale or the use of the asset. Okay. When do you carry out an impairment test? You bought a new car for 5,000. Okay. You bought a new car for 5,000. And the car has been involved in an accident after 2 months. If you want to sell that car, or if you want to continue using the car, let's take the sell first. If you want to sell the car, can you sell the car for the 5,000?
No, you can't sell it for 5,000.
Why?
No, you can't.
Why you can't sell it for 5,000?
At that stage, the car might have lost some.
The value.
Well, I'm listening. I'm listening to everyone. Why do you think the car, even if we did maintenance on the car, I'm sure it cannot be sold at what? At the 5,000. Okay. What might be the reason? What might be the reason?
Lose its value.
The car might what?
Lose its value.
Okay, through the accidents. Okay, the car might. Okay, that can also be an issue. Okay, so it means that if you want to sell the car, you'll be selling the car below what? 5,000, isn't it? So let's say you sold the car for 4,000. Okay, you sold the car for 4,000. It means that what? You are making a loss of what? 1,000. That 1,000 will be deemed to be what? An impairment, because you are selling the car for 4,000 because it has been involved in an accident. So the accident is an indication of what? Impairment loss. So if you have a car and the car is involved in an accident, the question that you have to ask yourself is, if the car will be taken, or if the car will be running at this speed after the accident, will the car be running at the same speed again? Would the efficiency of the car be the same again? If no, then you now determine what the car or the efficiency of the car. So what is causing the car not to run at the speed that it's supposed to run is the accident. So in that case, we can say that the car has impaired. So impairment, we carry out an impairment test when there is an indication. You don't just stand up and say you want to conduct an impairment on this particular asset. No, you bought a phone 5 months ago. Nothing happened to the phone. And you want to know whether the phone is functioning very well, or you want to carry out an impairment test on the phone. No, my brother. That is not what we call impairment. So if the phone fell down, you can see that, okay, as a result of this one, maybe the phone might not be functioning well again. So you can carry out impairment test on the what? On the phone. Because there is an indication that the phone might what? Impair, which is the accident of the phone what? Falling down. Okay, so impairment test companies carry out impairment tests on their assets with the mind of not carrying the assets at a value higher than what they should have recovered from the assets, either through sale or through a continual use. So the car was involved in an accident and the car was purchased at 5,000 and you still have the car at 5,000 in your financial statements. But they're not telling you that if you want to sell that car in the market currently, the car will be sold at what? 4,000. You can see that the company is carrying the car at a value higher than what they can get from what? From selling the car. What they can get from selling the car. Okay, so ideally, if the carrying value of the assets is higher than the recoverable amount, what do we call the recoverable amount? What do we call the recoverable amount? The recoverable amount is the is the maximum amount that a company can get from what? Using or selling the assets. So if you want to carry out an impairment test, we compare the carrying value with the recoverable amount. Okay, the carrying amount, we know what carrying amount is already. Okay, the cost minus accumulated depreciation minus accumulated impairment. The recoverable amount is the higher of net realizable value, which is net realizable value is calculated as fair value less cost to sell. Fair value less cost to sell. So if you are going to sell the asset for 5,500, but before you can sell the asset, you have to transport the asset to what? To the buyer. You have to transport the asset at 500 cedis to the buyer. Okay, if you are telling the buyer that you are going to sell the asset for 5,500, but before that you are going to incur a transportation cost of 500, the buyer will not pay for the transportation cost. In actual sense, how much will you be getting from the sale? How much will you be getting from the sale?
5,000.
5,000. So this 5,000 is what we call the net realizable value. The fair value is 5,500, but you are going to incur a cost to sell. So the transportation, you are incurring the transportation cost because you want to sell the asset. So that is what we call the cost to sell. Commission can also be a cost to sell. Agent fee can also be a cost to sell. So any cost that you are going to incur as a result of you selling the asset is what we call the cost to sell. So the net realizable value is the fair value less cost to sell. Okay, so the recoverable amount is the higher of the net realizable value or the value in use. Okay, we are going to look at what we call value in use. Value in use. Okay, if they say value in use, what is the meaning?
That would be value in use would be the cash flow that will be generated from the continuous use of the asset at the end of its useful life.
Solid. Okay, for this one now you have already passed the scope reporting.
For this one, I just said.
No, yes, for this answer right now, you have already passed the corporate reporting. MA will not do anything. The MA will not do anything. I receive it will not do anything. And then the MA itself will not do anything. The Amen will not do
Why?
Everything depends on you. So you will say, oh, amen, and I'll work towards that. Without the work there, it will never come.
Of course, we are working towards that.
No, talk for yourself.
Myself, I'm working towards that.
Exactly. Okay, so the value in use, what we are going to talk about as a value in use is what our brother has said. That is the cash flows that you are going to be getting when you continue using the asset. So the question now is, you have 3 years as a remaining useful life of the asset. So you are now making a decision as to whether you should sell the asset now or you should continue using it. So if you should continue using it, what will be the benefit that you'll be getting from the continual use? That is the value in use. What will be the benefit that you'll be getting from the usage of the asset if you continue using it rather than selling it? That is what we call the value in use. But mostly, what we do is that we want to carry out an impairment test today. So what we do is we find the present value of the future cash flows. We find the present value of the future what? Cash flows, not the present cash flows. We find the future value of the present value of the future cash flows. So value in use is the benefit that you'll be getting from using the asset rather than what? Selling it. So if you continue using the asset for 3 years, 5 years, what will be the benefit that you'll be getting from it? And that is what we call the value in use. Okay, and these value in use are always what? Discounted, because they will give you future values. And we want to carry out an impairment test today. So what should have been the value of those cash flows that we'll be receiving in the future? We find today's value of them. So we always find the present value of the cash flows. If you are finding the present values, what discount rate do we use and what cash flows do we use? Pay attention to this side very well. Couple reporting, the examiner likes impairment of assets. March, impairment came. July, impairment came. I will not be surprised if impairment will appear in couple reporting again, because the examiner likes what? Impairment of what? Assets. And the part of the impairment that the examiner likes is what we are coming to talk about. What discount rate do we use for the cash flows? What discount rate do we use for the cash flows? Pay attention here. What discount rate do we use for the cash flows? Okay, if you come to the discount factor we use discount factor, we use pre-tax cost of capital. Pre-tax cost of capital. Okay, the question will give you post-tax cost of capital or post-tax discount rate and pre-tax. We use what? Pre-tax, because the assumption is that we are not going to pay tax on the what? On the cash flows. We are not going to pay tax on the cash flows. Okay, so we use pre-tax cost of capital. What cash flows do we use? The question is, what cash flows do we use? We use pre-tax cash flows. Pre-tax cash flows. So the question can give you post-tax cash flows and post-tax cost of capital. And they will give you the two. They can give you the pre-tax and post-tax for the discount rate and then the cash flow. We use the pre-tax cost of capital and pre-tax cash flows. That's what we use. Okay. If you come to the discount factor 2, okay, if you are using we call something cash generating unit. Okay, I will talk about the cash generating unit and the cash flow, the discount factor that we use. Okay, in a situation where the assets, you have the asset in a foreign country, and you have a cash flow relating to that particular asset. What we do is that the cash flow that you'll be receiving will be in a foreign currency. Okay, so what you do is that you first have to present value the cash flows in the foreign currency and now translate it to your what? To your functional currency, or to the what? To the domestic currency, or to the local currency. So the company might be having an asset in Togo or Nigeria. Okay, there is an indication that there was a fraud, or there was a flood, and it is showing that the asset might be malfunctioning. It's a plant. So because this thing has affected the plants and it will not be functioning well again. So there will be an impairment test. There will be there will be a need for us to carry out an impairment test on that particular asset. So what do we do? If you look at the net realizable value side, you have the NARA and you know the amount that you are going to incur to sell the plants. So you find your net realizable value in NARA and now translate it to Ghana city, because the company is in Ghana and we present our financial statement in Ghana cities. Okay. If you want to look at the cash flows will also be given to you in the foreign currency, which will be in NARA. So you use the pre-tax cost of capital for what? The cash flows in NARA. So you have to present value the cash flows first in the foreign currency. Then you now translate the present value using the spot rate. The spot rate means the exchange rate at the date of the impairment test. You use it to translate it. Maybe we pick a question, then we know what we are talking about, or that will be dealt with under IAS 21. Okay, so for the value in use, what we do is that we use pre-tax cost of capital and pre-tax cash flows. That's what we use to present value the future cash flows. Okay. How do we account for an impairment, or when do we have an impairment? We have an impairment loss. We have an impairment loss when our carrying value is greater than our recoverable amount. So it means that the amount that we can recover from using or selling the assets is lower than the amount that we have in our books. It means that we are carrying the asset at a value which is higher than the value that we can recover from using or selling the assets. So if the carrying value is greater than the recoverable amount, we have an impairment loss. And this impairment loss is an expense. So impairment loss will be charged to statement of profit or loss. And the asset must be reduced to the recoverable amount, because the recoverable amount is now the new value of the asset. So accounting for an impairment loss is charged to profit or loss, and the assets will be reduced. The carrying value of the asset will be reduced by the impairment loss to reflect the recoverable amount. So the question now is, if our carrying value is 5,000 and our recoverable amount is 4,500, what will be the impairment loss?
$500.
Okay, so this 500 will be sent to profit or loss. We debit profit or loss with 500. Then we credit the asset with 500. We are crediting the asset because in our books we are having 5,000. So you have to go and credit the asset and now reduce it to 4,500. Okay, let's assume that our carrying value is 4,000 and our recoverable amount is 5,000. What will be the impairment?
No impairment. There is no impairment.
There is no impairment. And don't say that there is an impairment gain. No, we don't do impairment gain. So this one, there is no impairment, and the company will not recognize any expense in relation to an impairment. So you can carry out an impairment test and you realize that the asset has not impaired. So don't do anything. Don't do anything. Okay. If the carrying value is lower than the recoverable amount, it means that there is no impairment. So the asset is being carried at a value that it should be carried. So we don't do anything. We don't do anything. Okay. What do I want to say again? So basically, the asset that we carry an impairment test on are assets that are carried under the cost model. Basically, assets that are tested for impairments, or assets that we carry an impairment test on when there is an indication of that, is assets that are carried at cost model. Assets that are carried at revaluation model. At the end of every year, impairment is automatically carried on them. That is why we have a revaluation loss. The revaluation loss is equivalent to the impairment loss. The revaluation loss is equivalent to an impairment loss. So for assets that are carried under cost model, when there is an impairment loss, the impairment loss should be charged with profit or loss. Assets that are carried under revaluation model, when there is an impairment loss, it should be treated as how we treated or how we treat revaluation surplus. If the first revaluation was a gain, subsequent one was a loss, how do we go about it? That should be used to net the initial gain. Any difference, which is a loss, should be sent to profit or loss. So impairment of assets that are carried under revaluation model, the accounting treatment is just like the PP, how we treat the revaluation surplus and loss. Okay, so basically assets that are carried under revaluation model, we do impairment. We normally do impairment tests on them because at the end of every year, we carry the asset at fair value. So if the asset value is reducing, it means that the asset has impaired. But just that we don't call it impairment loss, we call it a revaluation loss. So last time I asked a question that I asked a question about impairment and this one, if impairment is technically called, if revaluation loss is technically called impairment, how do we have a separate standard for them? Okay, we have a separate standard for them because the revaluation model does not cover assets that are carried under cost model. So we have so many assets. Some of them are measured at fair value, but some of them will be measured at what? Cost model. So if there is an accident to that particular asset that is measured at a cost model, there is no way we can know that the value has increased or reduced. So the only thing that we can do is to have a standard which will account for the loss in the value of the asset through the accident. So for the revaluation loss, we do that for assets that are carried at the revaluation model. But those assets that are not carried under revaluation model, how do we account for their loss? How do we know that the value has reduced? Those are the assets covered by the what? Those are the assets covered by the IAS 36, which is the impairment loss or impairment of assets. So impairment of assets is basically what if the revaluation loss is beyond the previously gain? We know how to do that. So someone should answer that question. If the revaluation loss is beyond the first gain, what do we do?
It's charged to PNL.
The excess will be sent towards
PNL.
Okay. So HP, your question has been answered.
Please, which question are you solving?
A. But this time.
No, it's just demonstration. It's not a question. We are just demonstrating with figures.
Please, which question are you solving?
We are demonstrating with figures.
Auntie, let me check your name again. Auntie, what? Auntie Sulemana, can I move in peace or I should move in pieces?
Yes, please. Yes, please. You can move.
Okay. So that is for that. And also, impairments are done based on what? Conditions, preconditions. But revaluation surplus, we just look for the upward and downwards movement in the what? In the fair value of the assets. So whether there is an indication that the assets will be impaired, we will still fair value it. So revaluation is not done based on what? A condition. We just carry the asset at fair value. But for the impairment loss, we only carry an impairment test on assets when there is an indication that these assets might be likely to be impaired. Okay. So I've spoken a lot about accounting treatments, and we see that impairment is calculated as the carrying value compared with the recoverable amount. And I say that the recoverable amount is the higher of the net realizable value or value in use. So the question given to you, the question might give you the two. You find the net realizable value and you also find the value in use. Then you now compare which one is higher. Then you pick the highest one. It's just like they are telling you that if you want to sell the car is 5,000. But if you want to continue using it, you'll be getting 5,500. As a rational being, what will you do? Will you sell it or you continue using it? All things being equal.
You will use it.
You
You will use it.
So we always take the higher of the two. So we always take the higher of the two. Okay. I want to talk about testing for impairment. Then we look at causes of impairment. They can also ask you a theory question about that. Okay. We have two assets. We have two assets, two groups of assets, where whether you like it or not, yearly you have to carry out an impairment test on them. But for other assets that are having what? Definite useful life, we only carry an impairment test on them when there is an indication that the asset might impair. But we have two groups of assets or two categories of assets. Every year you have to carry out an impairment test on them. So assets that are, we have intangible assets with indefinite useful life, So assets with intangible assets with indefinite useful life, every year you have to carry an impairment test on them. A question can ask you, what are those assets that should be subjected to impairment test every year? The first asset should be intangible asset with indefinite useful life. Yearly, you have to carry out an impairment test on them. The second one is goodwill acquired through business combination. So goodwill that we normally calculate through control, through business acquisition, must be what? Subjected to what? Impairment test yearly. So goodwill acquired to IFRS what? 3, business combination. So the goodwill, you see the subsidiary, the goodwill that you are going to calculate upon the acquisition of the subsidiary, that particular goodwill must be subjected to what? A yearly impairment test. So we have two assets. Whether there is a condition or not, we have to subject them to a yearly impairment test. The first one is intangible assets with indefinite useful life, and goodwill acquired through what? Business combination. So this one, whether you like it or not, you have to carry out an impairment test on them, yearly impairment test. At the end of every year, you subject them to what? An impairment test. Okay, let's come to I've spoken about impairments, but they can also ask you about the causes of impairment. They can give you theory question where they will list some of the items for you and say you should explain whether that will be an indication for an impairment or that will not be an indication for an impairment. So the causes of impairment or indications of impairment, we have external indications or external indicators, and we also have the internal indicators. Okay. So we have external indicators and we have internal indicators. So the external indicators, what are some of the things that you think whenever they are there, the company should carry out an impairment test on that particular asset? If you have an asset and the government of Ghana, okay. If you have an asset, okay, you have.
Can you talk about inflation?
Yes, the inflation can also be a factor because the inflation is going to affect the rate that we are going to use to calculate the value in use. So if there's an inflation, it means that the discount rate will be increasing. So therefore, the value in use will also be low, because if the discount factor is higher, it will give you a lower cash flow compared to the current value. So the inflation can also be a factor, which we also call the economic factors. So the economic factors, the first one will be the inflation rate. Someone can also talk about the exchange rate. Okay.
Yeah, easy.
Okay.
Yeah.
So the inflation, we also have the economic factors,
Okay.
which is the inflation is one of the factors. What again? And I was saying something before. If you have a car that you are using to transport or you are using the car for your business, now the government has passed a law that nobody should be using that car again. What will happen to the car? What will happen to the car? What will happen to the car? Can you hear me?
Listen, I didn't hear the last part of your question.
Okay, I'm saying that you have a car that you are using for business. Government of Ghana has passed a law that no company should be using that car for business again. What will happen to the car?
You cannot
It
use it for the business.
You cannot
There
use
will
it.
there may be a change in use.
No, they are saying that you should not use it for anything at all. That car should not be used in the country at all.
It will come to naught.
It will be obsolete, so you cannot
Okay.
use it.
It will be useless, isn't it?
Yes.
And even if you want to sell it to someone, you'll be selling it below the actual value, isn't it? So
Yes.
government legislation is also one of the factors. Government can pass a law that the law or the legislation is going to make the usage of that particular asset to be worthless. The asset will not be for any use again. So we also have legislations. Can also be a factor. Okay, you are using the asset to produce some goods, and the government is saying that those goods will not be allowed in the country again. So it means that the asset is good for only that particular. The asset can only be used for the production of those goods. So since those goods are being banned from the country, it means that the asset will be worthless. It will be useless. You can't use it for anything again. So you have to carry out an impairment test on that. So we also have what we call the fall in demand. So if you have a situation where the asset is being used to produce a certain commodity, and they are now saying that the people that you have been supplying the goods to, they will not be able to produce or to purchase the number of quantity that you have been producing. It means that the assets now will be redundant, or we are not going to use it to up to full capacity, to just be there, and we will not be utilizing it fully. So in that case, you also have to carry out an impairment test on the asset and see whether the asset is still at its original value or something is happening. Okay. Someone can also say increase.
Sir.
Yes, sir. Yes, please.
Hello, sir.
Yes, please.
Yeah, let me take you back to the fall in demand.
Okay.
So what if the demand is there, but the capacity, the production, maybe the people are demanding 1,000, but the only capacity the machine could produce is 900. Can you say it's also underutilized, or maybe the technology is something?
The technology will come in when
Because in this case, you just explained that fall in demand.
Okay. The fall in you can see that the situation that you're talking about is an increase in demand. The asset cannot produce more than its capacity, isn't it? So every asset is being planned to produce up to a maximum capacity.
Yes.
So if our asset can only can only produce 900. It means that we need to get additional assets. So there will not be any issue of an impairment there because we are using the asset up to full capacity, which is the 900 units.
Okay.
There will only be an issue of impairment when you are underutilizing the assets. It means that the assets are supposed to produce 900, you are producing only 200, and the asset will be there. The asset will just be there. So that is why you ask yourself, okay, is there anything as we are underutilizing the asset? Will there be any situation where the asset will now be normal with what only the 200? So you just carry out an impairment test on the asset and see whether the asset can actually produce up to its maximum capacity. Because if you are producing 200, maybe the asset might be used to the 200. Might be used to the 200 because someone will tell you that if you buy a new car, the speed that you use for the car at the beginning, that is where the car will be speeding. But if you are driving the car at a lower speed or at a low speed, the car will be used to that particular speed. That is what someone told me. But I don't know it's true because I don't have a car. All right.
It's not true.
The car owners are talking.
Oh, the car owners are talking. There's no evidence. Okay. Increase in market value. Increase in market rate or interest. Okay. Increase in the market rate. Okay, the increase in market rate, we are only talking about the increase in the discount factor. What you have to know is that the highest discount factor will give you the lowest cash flow. So the interest rate is increasing. It means that the value in use will be reducing, and the value in use will be compared, or the value in use will be the recoverable amount that will be compared to the current value. So the value in use is reducing. It means that the current amount will be higher than the value in use. So we only look for the increase in the market rate because the market rate might be the discount factor we use for the what? For discounting the cash flows. Someone can also talk about technological advances. Technological advances. Technological advances. Okay. The issue might be you have a software, and there is what? A new software which can do, okay, we have Microsoft Office 2010, and we have 2013, now we have 2016, and we have 2019. It means that 2010 will now be what? Worthless. It will now be useless. And if you want to sell it to someone, you will sell it below the what? That particular amount. You sell it below its actual value. So if there is a new, is there?
People are still using it too.
People will still use it, but how many people are using it? Making something worthless doesn't mean that people will not use it. Okay. The issue is the number of people using it. That's what we are talking about.
Okay.
The number of people using it is if someone is saying that you are useless doesn't mean you are not useful to some people. You are useful, but the number of people that you are useful to are not plenty as compared to the number of people that you are. So that is so that is what they will say. So it doesn't mean that it will be worthless or it will be just be there. Nobody's going to purchase it. But if you want to sell 2010 Microsoft Office right now, some people will even be saying that you should dash them. You should dash them. So that is what we are talking about, and maybe mobile phones. If you are still using the Nokia 1100, those things, now we have iPhone and those ones. So those phones might not be useful to some people. So technological advances is also one of the factors that is going to make the asset worthless, or that is going to reduce the efficiency or the importance of the asset. Okay, let's come to internal indicators. Then we pick a question. Internal indicators. Internal indicators, the first one was to be physical damage. The asset has been damaged physically. So maybe accidents. Maybe accidents can be accident can be an issue. Okay, accident can be an issue. Another one is if you want to change the use of the asset, change of use. So if you want to change the use of the asset, someone might be thinking that it means that the asset that you want to use for the other one, the asset is not efficient for what you are using it for now. Okay, typewriter. Those days we have a typewriter, and now we have what? Laptop. Now we can type fast. So it means that if you are using a typewriter for typing, or you are using it to print documents, or you are using it to print exams for students, what you are going to do is now that you are now going to be using computer for the printing. It means that the typewriter can no longer meet the demand of the printing, or the typewriter is no longer useful for the printing. So what you do is that you now move the typewriter to a situation where you can use it. Maybe you use it for typing, or maybe you use it to print certificates, something that will not put pressure on the typewriter. So the company is changing the use of the asset. The assumption is that the asset is no longer useful to what they are using it for. That is why they are changing the use. So you have to see whether the asset has impaired or not. Okay. Another issue has to do with the company has a plan, or the company is planning to discontinue an operation that you are using the asset for. The company is trying to discontinue an operation that the asset is being used for. So you are using the asset to produce biscuits, and you have realized that no, the biscuit division is making a persistent loss. So what we do is that we want to sell that particular division off, or we want to stop producing the biscuits. It means that the asset will be made redundant. The asset will be made redundant. So that redundancy, we check to see whether the asset can still be sold for its value, or it will be sold lower than the asset. We can't just conclude and say that the asset has impaired unless we carry out an impairment test on them. So all these things that we are looking at over here, they are just an indicator. They are just an indicator for the company to be aware of carrying out an impairment test on the assets. It doesn't mean that if the inflation rate has increased, the asset will automatically impair. No. The inflation rate, the increase in the inflation rate is just telling us that the asset might impair. So let's carry out an impairment test on this particular asset. So these are all indicators. These are all indicators. They don't mean that the asset will automatically be impaired. They are all indicators. So you can only carry an impairment test when there is what? An indicator. Okay, I want to say this. All assets impair, including current assets, unless there is no condition telling you that this particular current asset might impair. Current assets impair. Inventory impairs. That is why we have the lower of cost and its net realizable value. If the cost is higher than net realizable value, the difference over there, which is the loss, is what we call an obsolete inventory. What is causing the obsolete inventory is the impairment. The asset is now old. So you can see that the duration of the asset is now telling us that this asset might be so below its fair value. So the obsolescence is now an indication of what? An impairment. If you count to a bad debt, if you count debtors, some of your customers are now declared bankrupt. They cannot pay you. So you have to review your debtors figure. You have to review your debtors figure. Why are you reviewing your debtors figure? It's because of the bankruptcy of some of the customers. So the bankruptcy now is an indication of what? The debtors impairing. So nobody should tell you that current asset doesn't impair. All assets impair. All assets impair, unless there is no condition telling you that this asset might impair. So have this in mind before we pick the example question there. Let's pick the example question there, which is a really. Auntie Eunice, are you there for us? Auntie Eunice, pick the example question for us.
Okay. Question number.
Example, just the example question there.
Hello.
Okay.
Can you hear it?
Page 2.
Company run.
Can you see the question?
Yes.
Okay, read it for us.
Really acquired a non-current asset on 1st October 2009, either 10 years before 2009, at a cost of 100,000, which had a useful life of 10 years and nil residual value. The asset had been correctly depreciated up to 30th September 2011. At the date the asset was damaged and an impairment review was performed. On 30th September 2014, the fair value of the assets less cost of the disposal was 30,000 and the expected future cash flow were 8,500 per annum. For the next 5 years, the current cost of capital of really is 10% required, with reference to the relevant IFRS, demonstrates how this transaction would be accounted for in the financial statement for the year ended 30th September 2015.
Okay. Before we move on to the question, I want to say this. If you are looking for the value in use, if the asset is going to be having a residual value, the residual value should be considered as part of the cash flow in the last year. Okay. So if the asset is having a residual value, the residual value will be considered as a cash flow in the last year. The residual value will be considered as a cash flow in the last year. Okay, let's look at this question. So before we can calculate an impairment, what do we need? Before we can calculate an impairment, we need what? What are the things that we need?
We need value in use, recoverable amount.
Carrying value and the recoverable amount.
Okay, we need the carrying value and what? We need carrying value and the recoverable amount. Okay, these are the two things that we need to know whether the asset has impaired or not. So the question now is, we have to determine the carrying value So we have to determine the person still wants to talk. Yes, I'm ready. Okay, so we need a carrying value and also the recoverable amount. But the question is, this carrying value that we need, at what date do we need a carrying value? We need a carrying value at the date of what? The impairment test. So when are we carrying out the impairment test? What date are they carrying out the impairment test?
September 2014.
2014. So we need to find the carrying value as at that date. We need to find the carrying value as at that date. So our carrying value will be calculated as cost minus what? Accumulated depreciation. Am I correct? Okay. So carrying value is not, the carrying value is not equal to, what is the cost of the asset?
100,000.
100,000.
We have to calculate,
Someone, please mute.
what will now be the accumulated depreciation? Okay. Accumulated depreciation will now be the 100,000, which is divided by 10, which is the yearly depreciation multiplied by the number of years that we have used the asset. Okay. The asset was purchased on which date? The asset was purchased on
October.
Okay. So if it is 1st October, can you hear me?
Yeah,
Okay. So
yes, we can.
if it is 1st October, it means that 29 to 210 is 1 year, isn't it? October to September,
Yes.
210, that is 1 year. Okay. 210 to 211 is what? Additional 1 year. 211,
Yes.
211 to 212 is additional 1. And 212 to 213 is additional 1. 213 to 214 September. So what will be the total number of years now? We have used the asset for how many years?
14. So 5 years.
5 years. So our accumulated depreciation will be the yearly depreciation multiplied by what? 5. So our carrying value will now be 100,000 minus what? Would that be 50,000? I'm getting 50,000 as a carrying value. Is that correct? Is that correct?
Yes, you are right.
Correct.
Yes.
Let's come to the recoverable amount.
Yes.
Yes.
Okay. The recoverable amount, we are saying that is the higher of the net realizable value and then the value in use. What is the net realizable value given to us in the question?
That's
30,000.
30,000. They have already subtracted the cost to sell. So the question now is, we have to determine our value in what? In use. How do we determine the value in use now? We have to find the present value of the cash flows, isn't it? Okay. Someone can decide to do it year by year. Someone can decide to do it year by year. Okay. But this is what? An annuity, because you'll be getting the 8,500 every year. So that is an annuity. You are getting a constant cash flow every year. That is an annuity. So I can decide to find the present value. I can put the years here, the cash flow. I'll put the discount factor here, which is 10%. Then I'll put the present value here. So the years I'll have 1 to 5. The cash flow will be 8,500. So the discount factor, I'll just find annuity and use it to discount the cash flow. Annuity is calculated as 1 minus 1 plus R. 1 minus, okay, let me do it over here. 1 minus into bracket 1 plus R exponent negative n, all divided by R. The R is the discount rate and the n is the number of years that you are going to receive the cash flow. So this can be calculated as 1 into bracket 1 plus 0.1 exponent negative 5 divided by 0.1. So you can do that on the calculator and give the answer to me. Or someone can do it yearly. The person can do year 1, 8,500. The person will calculate the discount factor for that year, which will be 1 over 1 plus r exponent n. So you can do it on yearly basis, but you are using time. So this will be appropriate if you are using an annuity. So let's find the annuity factor to 3 decimal places.
3.791.
3.791. So let's now multiply and get our present value. What are we getting?
That is
33,753.5.
Is it?
33,753.5.
3375.
no, it's
Sorry,
3.5.
Someone should mention it.
Yes.
3 what?
It's 3224.
3224.
Okay. Yes. Okay. You've run the 5. Yeah, that's right.
Okay. 3224. Okay. So our value in use now is 32,224. And our net realizable value is what? 3,000. So which of them are we going to pick as a recoverable amount? Which value are we picking as a recoverable amount?
The
The
32,000.
value in use.
3222.
So our impairment will now be calculated as the 50,000 minus 32224. What is the difference? Okay, someone can also, because you want to get a loss, someone can do it like this, 3224 minus what? 50,000. What is the difference?
negative
17.
17777.
776.
17
776.
776. Okay, so this is the impairment loss, which will be sent to profit or loss. So for September, statement of profit or loss. For September, we are going to have an impairment loss. We are going to have an impairment loss of 17,776. What are we going to have again? Statement of profit or loss. What do you think will come there again?
Depreciation.
We have depreciation for that year, which will be what? 10,000.
Yeah.
Yearly depreciation is 10,000. So in the statement of profit or loss, that is what we are going to have. But if we come to statement of financial position, we are going to have our asset. If it is plants, it will be plants here. Then we have 50,000 minus 17,776. And this will give us 32224. So after the impairment loss, the new value of the asset will be the recoverable amount. This is about this question. We solve more questions on this. But let's look at what we call cash generating units. Okay, cash generating units. Okay, if we talk about cash generating units, basically what we are talking about is an asset. You see, the asset that we have, the impairment that we have done right now, we are saying that the asset can independently generate a cash flow on its own. So the plants, we can use the plant to generate cash flow on its own. We can use the delivery van to generate a cash flow on its own. Okay, so if you take the delivery van, you can take your goods to the market and you sell it. So the asset can independently generate a cash flow. But we have some of the assets that cannot generate a cash flow without what? The assistance of what? Other assets. Okay. So if you say cash generating unit, we are talking about a business unit that generates a cash flow together, or a unit that cannot generate a cash flow on its own without the what? The assistance of other assets. Okay. The example that I will use over here is a provision store. If you have a provision store, you will see that before you can sell, you need to get table, isn't it? You need to buy the items. You need to have what? A sales girl or a sales boy. You have what? Lighting system there. Are you getting it? The assumption is that without a sales girl, the provision store cannot move. So you can see that a lot of things are now coming together to generate a cash flow at that particular point. So that is what we call a cash generating unit. The store itself cannot generate a cash flow on its own. A store itself cannot generate a cash flow on its own. We need the what? The item inside. We need lighting system. We need people that will be there and sell. And sometimes we have to buy from people on credit. We have to buy from people on credit. So an asset or a unit, a business unit that generates a cash flow as a whole is what we call a cash generating unit. Okay, or a business unit that cannot generate a cash flow on its own is what we call a cash generating unit. So a lot of things will be coming together to generate a cash flow. That is what we call a cash generating what? Unit. That's what we call a cash generating unit. Okay. Okay, so that's what we call a cash generating unit. Mostly I use the provision store because we are familiar with that. Okay. So this cash generating unit, the store can be there and there will be an issue of what? Flood. So there can be an issue of earthquake. The last time I heard that there was an earthquake in Accra, was that true? Somewhere they said that the building was shaking or something. Because we are Africa, we try to modify the thing. Okay. So there can be an issue where we be having, maybe there'll be an issue that like soil erosion where the location of the cash generating unit, if you want to sell it to someone, the person might not be willing to buy it because of the location. The location is now making it not to be attractive. So if you want to sell it, you might be selling it below its carrying amount. Okay, because there was a flood, there was something there, you cannot sell the cash generating unit at a value that you have to sell it. Okay, or there was something that happened to the cash generating unit and the amount of cash that you should be generating every day has reduced. So what do? We carry out an impairment test on a cash generating unit. The cash generating unit is mostly going to have more than one asset. It's mostly going to be having more than one asset. So if you carry out an impairment test on a cash generating unit and there's an impairment, how do we share the impairment? How do we share the impairment? The impairment is being shared in this manner. So this is how we share the impairment among cash generating unit. The first one is we ask ourselves, is there any physical damage asset? Is there any physical damage asset? If there's any physical damage asset, the impairment will be given to the physical damage asset. So if the impairment was 25 million and the physical damage asset is 5 million, if the asset has damage physically, it means that we can't use it for anything. So 5 million out of the 25 impairment will be allocated to this one. So if we have allocated the 5 million, we'll be having 20 million. How will the 20 million be shared? Then you ask yourself, is there any goodwill associated with the cash generating unit? You can't be saying that you have a good name when your location is now a problem. You can't be saying that you have a good name when your employees cannot meet the demand of customers. What is a good name? So the first one, the second one is we share the impairment to goodwill. So if there is any goodwill in the question, then the impairment will be given to goodwill after the physically damaged asset. So if the impairment was 25 million, physical damage is 5 million, goodwill is 10 million, it means that we'll be having 10 million as the remaining impairment. Okay, the remaining 10 million now will be shared among what? The remaining assets. The remaining assets, the question might tell you that some of them has not impaired. So if you are sharing the impairment, don't share the impairment to those assets. So the question will say that this asset is having a carrying value or a fair value of this. Sometimes they will give you a fair value which will be higher than a carrying value, telling you that that particular asset has not impaired. Okay, so you now share this, the remaining 10 million to the remaining what assets, which are likely to be impaired. The question will tell you the asset that has not impaired. So if you are sharing the 10 million, you will share the 10 million to them. So the remaining 10 million will be pro rata to the asset that will impair. How do you pro rata it? We now share it in proportion of their what? Their carrying value. So the asset that might impair, we add their values and now what? Find the proportion, like ratio and proportion. So if you have 3 assets and their values are 15 million, 25 million, and 10 million, what we do is that their total value will now be 50 million. So we share it 15 over 50 times 10 million. That's how we share it to them. So that's all about the cash generating units. And that's how we share the goodwill. Let's look at that example question there. Let's look at that example question there before we move on to questions that will be technical. Auntie Eunice, are you there? A company runs
A company runs a drop in income due to failure of its technology. Let's generate it. The following carrying values were recorded in the books immediately prior to the impairment. Goodwill 20 million, technology 5, plants 10, building 30, land 50, other net assets 40. The recoverable value of the unit is estimated at 85 million. The technology is worthless following its complete failure. The other net assets include inventory, receivable, and payables. It is considered that the book value of other net assets is a reasonable representation of its net realizable value. Required. Show the impact of the impairment on January 1.
Okay, on January 1, 2x8, that's what they are saying. Okay, so the issue is you can see that they have given you the carrying value of the asset at the date of the impairment, isn't it? So what you do is you have to total the value. You have to find the total value. You have to find the total carrying value of the assets. So those are the carrying value given to you over there. So we have goodwill. How much is goodwill? 20 million, isn't it?
Yeah.
Okay.
Yeah.
We have technology. Technology is how
5.
much? 5. Okay. The
Brand
plants is 10.
10.
Okay. And we have building.
Okay.
Building is what?
30.
30. Then we go to
Land
land.
50.
Land is 50.
Other net assets
Other net assets
40.
40. So let's put the total together. Let's find the carrying value of the cash generating unit. Add all of them and give me the value.
1.5.
155. Okay, this is the carrying value before the impairment. This is the carrying value. What is the recoverable amount given to us now?
85.
85. The recoverable amount is 85. So you can see that the asset has impaired, isn't it? So let's calculate the
It
impairment
is
loss. So impairment loss
70.
Impairment loss will be 85 minus 155. That will give us what?
70.
Okay. So the question now is, how do we share the 70? How do we share the 70?
Useful.
How do we share the 70? How do we share the 70?
Okay, Lana, so based on the how we have to share it, the fit to be the first that is damaged, then we go to goodwill, then we do it based on pro rata basis. So
Are you
in
going
this
to?
question,
Okay.
in this question there, he said the technology is worthless. So that would be the first item. That would be we take the technology out, then the goodwill, then we share it to branch, building, land, and the other branch, building, and land, exclusion of other net assets, because he said the value is not impaired. Thank you.
Okay. So the total impairment loss is 70. So we can take the 5 for the technology, and we can also still take the 20 for goodwill. Okay. So 5 for technology, 20 for goodwill. What will be the remaining portion of the impairment?
45.
Okay.
Right.
So the remaining 45 will now be shared among the assets that are likely to impair. So you can see that they are saying that the other net assets include inventory, receivables, and payables. It is considered that their book value, the book value of the net asset, is a reasonable representation of its net realizable value. So it means that the value that we are seeing over there is the same as their net realizable value. So the impairment loss is 0. So it means that they haven't impaired. But since they didn't say anything about the branch, building, and land, we assume that their impairment put together is what? 45 million. So we have to come and share their impairment loss. So the first thing is we have to put their value together. What will be the total value of them? 10, 30, and 50. What will be the total value?
90.
So Brown will be taking 10 over 90 times 45. Okay. Building will be taking what? Building will be taking
30 over 45.
30 over 90 times 45.
90,
Okay.
45.
And land will now be taking 50 over 90 times 45. So what will be the impairment loss for each of them?
Land will be 25.
Land will be 25. Okay.
Building will be 15.
Okay. And this will be
5.
okay. So after doing the impairment, then you now come and show the carrying value of the asset after the impairment. So you come and show it after the impairment. So the first one will be, you bring the goodwill. So you show the carrying value after the impairment. You show the carrying value after the impairment. So you are going to have a goodwill dash, because after the impairment, there won't be any goodwill. You bring the technology. Technology will also not be having any what? Carrying value again. Then you now count to the next one. The next one will be the brand. The brand was 10. Now it has impaired by 5. So the carrying value will now be what? 5. Then you count to building. Okay. The building was 30, and it has now impaired by 15. So it will now be what? 15. Then you count to the land. The land was 50 and it has impaired by 25. It means that the carrying value after the impairment or the recoverable amount will be 25. Then you count to other net assets. Other net asset, there was no impairment, and this would be 40. All of them should give you 85, which is a recoverable amount. That's how we go about the cash generating units. You first have to determine the impairment loss, then you share the impairment loss based on the what? The asset that has been physically damaged. You look for goodwill, then you share the remaining one among the assets that are likely to be impaired. What you have to know is that if the question should have said that, the question should have said that the carrying amount, or the recoverable amount of the building, was 20 million. Okay, the question says that the recoverable amount of the building was 20 million. Then the building should have impaired by how much? The question says that the recoverable amount of the building,
25.
the recoverable amount of the building was 20 million. Then the building should have been what? Should have been impaired by what?
Impaired by
By 10.
10 million.
Okay, by 10. What I want to say is that when you are sharing the impairment, don't share the impairment, or don't write the impairment, or don't write the value of the asset more than the net realizable value. Sometimes the question will give you the net realizable value of the asset. So they can say that the net realizable value of the building is what? 20. But if you share the impairment loss, you can say that building is getting 15. No, if you are writing building 15, it means that the carrying value of the building will be 15. Once the question is telling you that 20 million. So don't write it below the what? The recoverable amount that the question will be given to you. So sometimes you see that the asset has impaired, all right, but they will give you a recoverable amount. You can only recognize an impairment to what? To the difference between the carrying value and the recoverable amount. So the building was 30. The question is telling you that the net realizable value is what? Is 20. It means that the impairment that can be recognized on the building is 10, which is the difference between the carrying value and the net what? Realizable value. Don't write the impairment loss beyond the what? The recoverable amount of the asset. The question can give you the recoverable amount, and you calculate your impairment. You see that the impairment loss on that particular asset is higher. No, don't take all the impairment. Take the impairment to the difference between the recoverable amount and the what? The carrying value. If the 5 million over here, this 5 million over here, if the question have given you the fair value of the land, which you see that the 5 million can still be written against the fair value of the land for us to get the actual fair value of the land, then you can take the 5 million to the land. But if the land cannot take the 5 million, you ignore it. If the bank cannot take the 5 million, then you ignore the 5 million. All right. There can be a question that will be like that, and we are going to pick a question that will be like that. Okay. Let's come to reversal of an impairment. Reversal of an impairment loss. Okay. We say that impairment is not something that we should be doing annually. We carry out an impairment test on an asset if there is an indication that the asset might be impaired, or we carry out an impairment test on assets on a condition or based on a condition. Okay. It might happen that what is causing the impairment loss today might not be there maybe in the future, might not be there before the asset will be what? Will be exhausted. So you have a car right now that you are using for delivery. The government of Ghana has passed a legislation that no company should use that car for delivery again. So in that case, you are going to park that car, and that car will become useless, will be deemed surplus to requirements. So automatically the car has impaired. Okay. But the question is, after 2 years, the government of Ghana has lifted that particular ban, and those assets, you can still use it. If you still have the asset there, it means that you will still be using the asset for delivery. It means that the asset is no longer what? Impaired, because the condition or the indication or the condition that is causing the impairment is no more there. It's not favorable. First, it was unfavorable. Now it is favorable. So you can still engage the asset fully now. It means that the asset is not impaired. So what will you do to the previous what? Impairment? What will you do to the previous impairment that you have recognized on that particular asset? Because now the asset is fully engaged. There is no indication of impairment and there is no impairment. What do we do? What you have to do is that if the condition causing the impairment is no longer there, what you have to do is that you have to ask yourself, assuming the impairment was not conducted, what should have been the carrying value of the asset? Okay, what should have been the carrying value of the asset? Let's look at this situation. The asset was bought for a certain amount, but the carrying value of the asset now is 20,000, and the asset has a remaining useful life of 10 years. Okay. The recoverable amount of the asset at this date is 15,000. Okay. And we have recognized what? An impairment loss of 5,000 on the what? On the asset. Okay. After 2 years of using the asset, we have now realized that the condition causing the impairment is no longer there. So the asset has not impaired. So now the net realizable value or the recoverable amount of the asset is now 30,000. That's what they're telling us, that the recoverable amount of the asset now or the net realizable value of the asset now is 10,000, is 30,000. If the impairment is no longer there, people will be willing, or the asset will be useful, and people will be willing to buy it at a what? At a higher amount. Okay. This was given to us after 2 years. The question is, after impairment carry on this asset, which is 5,000, what will be the annual depreciation of this particular asset? Before the 2 years, what will be the annual depreciation of the assets?
It will be 2,000.
Are you sure? The carrying value of the asset with the remaining useful life of 10 years. The recoverable amount at that date is 15,000. So we have recognized a loss of what? 5,000. So the asset will now be carried at the recoverable amount.
Recoverable amount, yes.
So this will be 15,000 divided by what?
Over 10 years.
Over 10 years. So every year will be what?
1,005.
Okay. So let's come here. So after 2 years, they are now telling us that the recoverable amount of the asset is what? Is 30,000. It means that the carrying value of the asset after that 2 years will be the 15,000 minus 3,000. Am I correct with that? That will give us 12,000. Okay. Compared to the recoverable amount, you can see that the value of the asset is now what? Increasing. The value of the asset has increased by 18,000. Okay. You have recognized what? An initial impairment loss of what? 5,000. Don't say that the value of the asset has now increased. You are going to reverse the impairment loss of what? The 5,000. No, that's not what you do. The question
They went for the 3,000.
The 3,000, the depreciation for 2 years.
Oh, okay.
Okay. So you can see that the value of the asset has increased by what? 18,000, and you have incurred an impairment loss of 5,000. Don't say that you are going to reverse the impairment because the asset has not impaired. So you are going to reverse the 5,000. No. If the recoverable amount of the asset has not increased, it means that the asset has not impaired at all. If the asset has not impaired at all, what should have been the carrying value up to this date? If the asset has not impaired at all, what should be the carrying value up to this date? So the question now is, if the asset has not impaired at all, our depreciation every year would have been 20,000 divided by 10, which is 2,000. So the carrying value after the 2 years would have been 20,000 minus what? 4,000, which will now be 16,000. But in the books, we are having a carrying value of what? 12,000. But if the impairment has not impaired, our carrying value should be what? 16,000. So how much should we add to the 12,000 to now have what? the 16,000.
4,000.
4,000.
So that 4,000 will be the reversal of the impairment. Do you know why we are doing the 4,000 as the reversal of impairment? Because if the impairment has not occurred, our annual depreciation should have been what? 2,000, isn't it? But with the impairment, what is our depreciation now?
1,005.
1,005.
So it means that we have undercharged our depreciation by 500 for 2 years, isn't it?
Yes.
And this is the 500 that is reducing the 5,000. It means that the impairment is now making us not to charge depreciation of 500 for the 2 years. So since you are reversing this, it means that the depreciation should have been charged on this. So depreciation for 2 years, 500 will be 1,000. Subtract 1,000 from this, and that will give you the 4,000. So this will be the amount that you are going to reverse as a reversal of impairment loss to profit or loss. So if the impairment is no longer there, ask yourself, what should have been the carrying value of the asset if the impairment does not occur at all? Then you look for that carrying value compared to the carrying value that you have under the impairment. Then the difference should be treated as the impairment or the reversal of the impairment loss. Settle.
So what figure goes into the financial position?
4,000 will be added to the 12,000 that we have.
And then the same 4,000 will go to the P&L.
P&L. So you debit the asset and credit
The asset. Oh, okay.
and credit the P&L because you are increasing the value of the asset. Okay. So let's pick a question on that. I want to pick a question. Let's pick okay, I can't see a question. I have a question on that. Let's pick question 17. Tutorial question 17. And let's pick some additional 2 questions on that. Then I don't think I'll do the non-current asset also. I'll do it on Saturday together with another standard. But I can start though. If we have time, I'll do introduction. Then next week we continue.
Current asset compared to 2020, the cost of $30,000. At that date, the asset had an estimated useful life of 10 years. Boxer does not revalue this type of asset, but accounts for it on the basis of depreciated historical costs. At 31st December 2012, the asset was subject to an impairment review and had a recoverable amount of 16,000. At 31st December 2015, the circumstances which caused the original impairment to be recognized are reversed and are no longer applicable, with the result that recoverable amount is now 40,000. Required. Explain with supporting computation the impact of the financial statements of the 2 impairment reviews.
Okay. So the question is, when was the first impairment conducted?
2012.
Okay. At the end of the year, isn't it?
Yes, that's very
Okay.
December.
So the cost given to us now, you can see that the boxer purchased a non-current asset on 1st January 2x1 at a cost of 30,000. At that date, the asset had an estimated useful life of 10 years. So from the date of purchase to the date of the impairment loss, how many years or how many months is that?
So that's 2 years.
Yes.
That is 2 years. So we have to find the carrying value of the asset at the date of the impairment. That is the end of the year, which is 31 December.
Question.
Is that?
Question. The question number.
17.
17.
Thank you.
All right. So let's calculate the impairment. Let's calculate the carrying value at the date of the impairment. We compare with what? The recoverable amount. Okay. So can we say that the carrying value will be 30,000 minus 30,000 divided by 10 times 2? Is that correct?
Yeah.
Yes.
So we have 30,000 minus what? 6,000. And that will give us 24,000. So let's look for the impairment loss. The impairment loss will now be the recoverable amount, which is 16,000. Or since you are writing a loss, then it will be 24,000 minus the 16,000. What is the impairment loss?
$8,000.
8,000. Okay. So that is the impairment loss now. Okay. So the asset will now be what? From January 2x3 rather, the carrying value of the assets will now be 16,000. Will now be 16,000, and this will be carried for what? The remaining 8 years. Am I correct?
Yes.
Okay. So when are they telling us that the impairment, the condition causing the impairment are no longer there? When are they telling us that?
expired.
Okay, how many years? It will be how many years after the impairment?
3.
3 years. So we have to find the carrying value at that date. The carrying value will be based on what? This particular value, 16,000. Because after the first impairment, the asset will be carried at 16,000. So that will be 16,000 divided by the remaining useful life, 8 times 3. Am I correct?
Yeah.
Yes, you are.
So the carrying value will now be 16,000 minus what? 6,000. So I'll be having 10,000, isn't it?
Yeah.
Okay. But what is the recoverable amount?
40,000.
So you can see that the value of the asset has increased by what? 30,000, isn't it? The value of the asset has increased by 30,000. Okay. That is telling you that the impairment has not occurred at all. So don't say you are going to add the 30,000 to what? To the 10,000, because you are not carrying the asset at what? Revaluation model. You are not carrying the asset at a revaluation model. So if you are carrying the asset at a cost model, that the assumption is that the revaluation should not be what? Or the impairment should not have been carried out at all. So what you do is that the impairment that we recognize was what? 8,000. Don't say that you are going to add all the 8,000 to what? To the 10,000. No. Because the impairment that we recognize was 8,000. Don't say that since the value has increased, it means that you are going to reverse all the 8,000. No. If you are reversing the 8,000, all the 8,000, it means that from the date of the impairment, the 8,000 should also be depreciated. So what we do is that if the condition causing the impairment is no longer there, it means that the impairment has not occurred at all. The impairment has not occurred at all. So if the impairment has not occurred at all, what should have been the carrying value of the asset up to this date? Up to the day that you are reversing the impairment. If the impairment has not occurred at all, it means that our cost will still be 30,000 and the asset will be used for 5 years. So what will be the carrying value? What will be the carrying value? The carrying value will be the cost into brackets 30,000 divided by 10 times 5. Because up to the time that we are reversing the impairment, it was 5 years after purchasing the assets. So if the impairment has not occurred at all, it means that the asset will be used for 5 years, which it will be carried at 30,000, and the accumulated depreciation will be 30,000 divided by 10 times 5. And that will give us 30,000 minus 15,000. And that will give us 15,000. So if the impairment has not occurred at all, or the impairment was not carried out at all, the carrying value of the asset based on the original cost should have been 15,000. But what was the carrying value under the impairment after we have impaired the asset? What is now the carrying value of the asset? What is now the carrying value of the asset?
10,000.
10,000. But the actual value should have been what?
15.
So what do we do?
We reverse the impairment.
5,000.
So we add 5,000 and send 5,000 towards profit towards or loss. We are not reversing the 8,000 because if the impairment has not occurred at all, depreciation every year should have been what? 3,000. But after carrying out the impairment, you will see that the depreciation every year is what? 2,000 for 3 years. So you are undercharging your depreciation by 1,000. So since you are assuming that the impairment was not incurred at all, it means that those depreciation, which is 1,000, and that should have also been taken to profit or loss. So that is why the 1,000 times 3 will be 3,000, which is in the 8,000 impairment loss. So you take the depreciation that should have been charged to profit or loss from the total impairment loss. The difference will be the reversal of the impairment. So it means what the meaning is that the impairment loss of 8,000 has reduced the value of the asset. So what would be the depreciation on that particular figure? It would have been 8,000 divided by 8. So it means that since we have reduced the value of the asset by this amount, it means that depreciation of the asset will also be reduced by 1,000 every year. But since the impairment is no longer there, it means that the reduction of this depreciation should have been sent to profit or loss. So let's send it now there and now bring the carrying value. So if the 8,000 we have used it for 3 years, it means that we have used 3,000 already. Need to be remaining what? 5,000. That's why we are adding the 5,000 to that place. Or if you can't think about it like this, just ask yourself, what is the carrying value under the what? The impairment. And what should have been the carrying value if the impairment has not occurred at all? So you look at the carrying value, the impairment has not occurred at all, compare with what? The carrying value that you are having under the impairment. You look for the difference. The difference should be added to what? To the asset. And that difference should be taken to what? To profit or loss as an income, because you are reversing the impairment. You are reversing the impairment. That is basically about the reversal of impairment loss. All right, let's pick a question. Let's pick the last question. 21. Question 21.
Okay, question 21. Sando Limited is a company which manufactures machinery for industrial use and has a year end of 31 December 2021. The directors of Sando Limited require advice on the following transaction. A. Sando Limited acquired a car generating unit several years ago, but at 31st December 2021, the directors of Sando Limited were concerned that the value of this CGU had declined because of a reduction in sales due to new competitors entering the market. At 31st December 2021, the carrying amount of the asset in the car generation unit before any impairment testing were PPE 20 million, goodwill 6 million, other assets 38 million. B. The fair values of the property, plant, and equipment in the other assets at 31st December 2021 were 20 million and 34 million respectively. And their cost to sell were 200,000, 600,000 respectively. The CGU's cash flow forecast for the next 5 years are as follows. Date here, pre-tax cash flow and post-tax cash flow. C. The pre-tax discount rate for the CGU is 8% and the post-tax discount rate is 6%. Sandow Limited has no plans to expand the capacity of the CGU and believes that a reorganization would bring cost saving, but no plan has been approved. The directors of Sandow Limited need advice as to whether the CGU's value is impaired. The following extract from a table of present value factors has been detailed below. Discount rate at 6%, discount rate at 8%. Required a reference to relevant international financial reporting standards. Advise the directors of Sandow Limited on how the above transactions should be accounted for in the financial statement as at 31st December 2021.
That's all. Is that
Yes,
all?
senior.
Okay.
Yes, senior.
So let's look at, you can see that the carrying value given to you before the impairment, they will always give you the carrying value before the impairment. So you can see the carrying value over there, 20 million, 6 million, 38 million, isn't it? Okay. The B, the fair value of the property, plant and equipment and the other assets at 31 December 2021 were 20 million and 34 million respectively, and their cost to sell were what? 200,000 and 600,000 respectively. What do you think they are giving you this information for?
For net realizable value.
They are giving you this information to compute the net realizable what? Value. So the first thing is we have to compute the net realizable value, and also we come and compute the a minute. Okay. So first of all, let's put the carrying value of the asset there. Let's put their carrying value there. Okay. So we have PPE. What is the carrying value of the PPE? 20 million. Goodwill is what? 6 million. Other assets? 38 million. So the total is 64 million. So let's now find their net realizable value. Let's find the net realizable value of the assets. So the net realizable value will be, we can find it for them one by one. So we can find the net realizable value for the PPE and that of what? The other asset too. Then you add all of them. You can see that they are telling you that the goodwill has totally impaired based on the first information that we have, because the goodwill is not having any net realizable value. They are not giving any information about the goodwill. It means that the goodwill has automatically what? Impaired.
Yeah.
All right. So let's look for PPE. What would be the net realizable value for PPE? That would be 20 million minus what? What is the cost to sell?
0.2.
Okay, that would be 0.2. So what are we having?
19.8.
19.8. Let's come to other assets. The cost, this thing is 34. Cost to sell is what? 0.6. So now give us 33 points.
There is it 38 or 34?
It depends on where you are reading from.
Oh, okay.
The side that you are reading from is different from the side that we are reading from, because you can I can see 38, I can also see 34. we are looking for the net realizable value. The 38 is the carrying value of the asset. So the net realizable value is the fair value less cost to sell. So we are coming to find the net realizable value. So we use the fair value, then we less the cost to sell. So that will be 33.4. What will be the total net realizable value? 53.2. Is that correct?
Confirm.
Yes.
Let's now count to. So the next thing that we are coming to do is to find a value in use, isn't it? So we have to find a value in use because they have given us cash flows, and the cash flows will be used to what? Find the value in use. The cash flows now, we have a pre-tax and post-tax. Which of them are we using?
Using the pre-tax.
Okay. I pray that you should not be, you have it in your head only for today. It should be in your head forever. Okay. So we have the cash flows, we have the discount factor, and we have the present value. So we look at the years, we start from Benjamin.
Sir,
Yeah.
please, why are you the pre-tax?
Why are we using the pre-tax?
Yes, sir.
Yeah, because we just joined.
Is that?
Because we just joined, that's why we are using the pre-tax.
Oh, say.
Yeah?
I can't hear you. What do you say?
He
I'm
said we
saying
have to
that-
use pre-tax.
I'm saying that you just joined. That's why we are using the pre-tax.
Okay.
Can you hear me?
Oh, so we are also taking it like that.
Yes.
So when you get to the exam and you join, you started the class, you started the exam with us all. Are you going to use posters?
No. I'm saying he just joined because I've explained why we use the word. The pre-tax, I've explained that.
But please, can you come again?
Oh no, I have mostly whatever I'm coming to say, I have whenever I'm eating, I have a budget for how I'm going to spend my food.
Okay.
And so how I'm going to talk, I normally plan it. I don't want to get exhausted before the class. Okay, but I'll try and see if I have some left over there so that I can explain for you. Okay.
Hey, accountants. Accountants and budgeting.
So we are using a pre-tax. We are using the pre-tax because we are here to what? To generate the cash flow. We are here to generate the cash flows. We are here to generate the cash flows. And the cash flows that we are going to generate, the discount rate that we are going to use will be a pre-tax cost of capital because the asset that we are using to generate this one, we don't pay tax. We are not going to pay tax on the asset. The asset is not something that is going to be a debt. We are not using debt to purchase the asset where we are going to say that, okay, since we are going to pay tax on the interest, we need to find after tax cost of what? Capital. No. So the cash flows, we are here to generate them, and the asset itself, we are not going to pay tax on them. We didn't purchase the asset through acquisition of or through debt funding or something. So since we are here to generate the cash flow, and we don't even pay tax on the asset, or we are not going to pay tax, or we are not going to enjoy any tax benefit on the asset in terms of interest. So we use the pre-tax what? Cost of capital. All right. So the cash flow, the pre-tax cash flow. Okay, the cash flow for the first year is what? 16. Okay. What will be the cost of capital that we are going to use? Is it pre or post?
The pre, which is 8%.
8%. Okay. And you can see that they have given that to you already. So you can see that is 0.8. 9259.
So and
So it's Fala, isn't it?
this
Okay.
not that far.
This one is Fala chop. Okay. 0.8998900. Okay, let's count to 2024. I said that we discount future cash flows. So if the question give you today cash flow, ignore it. We discount what? Future cash flows. Or if they give you today one, it means that you're not going to discount it. You can just discount all and add that particular one to it. So the discounting is always based on future cash flows. So we have A. This is supposed not to be 0.99, 0.899. It's supposed to be
8573.
okay, 0.8573. So 0.7938. 2025. The cash flow
Hello,
is 6. Yeah.
Alex.
Yes, please.
Yeah, about the tax. So are you saying that we should ignore any capital gains tax on these assets?
Any capital
Gains tax.
We don't have any leaks asset in the question here.
Okay.
No, but Philip, these rates are linked to interest, and what he's saying is that the assets which will be generating these cash flows are not being financed by debt, whereby you use the post.
But how do we know? Did the question state that this is not financed by test, or we assuming, because there are too many assumptions here for me.
In the exam hall, use pre-tax cost of capital and pre-tax cash flow for every examination question.
Okay, thank you. This is rather helpful. Thank you.
You are people. Okay, let's move on. So we have 0.7350 and we have 0.6086. Okay, let's find the present value one by one. 16 times 0.9259.
14.81.
8144.
81, 2 decimal place will be okay.
Okay.
12.
12.
For 2024, 7.94.
No, you should take it one by one. 12 point what?
00.
Okay. 2024.
7.95.
7.95. Okay.
4.41.
4.4.
This month's margin for 2026 is 0.6806.
Okay, thank you.
The 2024 will be 7.94.
17.7.
17.70.
70. So let's add up. Someone is saying something.
Please, the 2024 is 7.94, not 95.
7.94.
Yes, please.
Yes.
Okay. Okay, let's add up.
6.886. 56.86.
56.86.
Yeah, 56.86.
Okay. Which of them are we picking?
We are picking.
We are picking the higher. So we are picking
the 56.86 as the recoverable amount.
So let's find the impairment loss now.
Okay, so 86, 56, 64.
164.
It's 7.14.
7.14 million. This is the impairment loss, isn't it? Okay. You can see that the question
Yes,
says
it
this is a cash generating unit. So you have to use how the impairment should be shared. We don't have any physically damaged assets based on the question. So the second one will be goodwill. So the goodwill will be taken care of. So the goodwill figure is what? 6 million. It means that the impairment goodwill will take what? Goodwill will take all the 6 million. So if the goodwill takes the 6 million, then what will be the remaining portion of the impairment?
1.14.
1.14.
Okay. Based on this one, let's look at this place. Let's come here. What is the net realizable value of this particular asset? The PPE. 19.8, isn't it?
Yeah.
Compared with the 20 million, the PPE has impaired by how much?
0.2.
The PPE has impaired by what? 0.2, isn't it?
Yeah.
So it means that the only impairment that we can take care of over here for PPE should be 0.2. Because based on the net realizable value, we can get 19.8 from the PPE. It means that the PPE has impaired by only 0.2. So don't come here and say that you are sharing the impairment of this based on 20 and 38. Don't do that. You can only do that when you are not giving the recoverable amount for each of the items separately. They have given you their recoverable amount, and the recoverable amount for PP is 19.8 compared to the current value. So it means that the recoverable amount is 19.8 compared to 20. The PP has impaired by only 0.2. Let's count to the other assets. What will be their impairment? The other asset.
Impairment. Impairment for the other asset. 0.6.
Are you sure? I'm getting 4.6. It will be 38 compared to their net.
It's 4.6.
Yeah.
Okay.
4.6.
Okay. That should have been the actual impairment, isn't it?
Yes.
But the total impairment that we are having is what? 7.14. Goodwill is taking what? 6. PP will take what? 0.2. Then the remaining will be what? What will be the remaining?
0.94.
0.94. So other assets will take the remaining what? Impairment. Don't say it will impair by 4.6. No, the total impairment is what? 7.14. But in actual sense, the impairment should have been what? 4.6. So the 0.94, should be the impairment charge towards the other assets. Because this is don't say they have impaired by 4.6, so that is the total impairment. No. Using the recoverable amount, which is the 56.86, our total impairment was what? 7.14 relating to the cash generating unit. So goodwill has taken 6, PP has taken 0.2. The remaining portion will go for what? Will go for the other net assets. But let's come here. Assuming the impairment on the other net asset should have been this. Comparing the net realizable value and the current value, the impairment on the other net asset was 0.74. Are we going to charge all the 0.94, or how much are we going to charge? Assuming the difference between their current value and the recoverable amount here was 0.74. And the impairment left is 0.94. How much are we going to charge to impairment for the other assets? How much are we going to charge?
Charge the 7.4.
We charge only the 0.74. We can't charge more than the impairment, or we can't charge, or we can't reduce the value below the recoverable amount given to you. So sometimes the question can give you the recoverable amount to each of the what? The items, the assets separately. You can only reduce the value of the asset to its recoverable amount. So this is how you are going to share it. Don't say you are coming to share 1.14 based on the what? The proportion of the PP and those ones. No. If you are doing that, you'll be reducing the PP below its recoverable amount, which is wrong. Which is wrong. All right. So after this, you will now show your assets now. Goodwill, after the impairment, make sure you always show goodwill will be dash. PP will be 19.8. Other assets will be 38 minus 0.94. What are you going to be getting there? 38 minus
37.06.
37.06. So let's add the 2 and see.
56.86.
Okay. So this should give you the recoverable amount. That's all. That's all about this question.
Salina.
Yes,
Yeah.
please.
Hello, Salina. Please, the PP 19.8. If you can go over it.
No, I don't have anything over here to go over. Maybe I don't understand the go over that you are talking about.
I know goodwill. I know the impairment loss is 7.14, right?
Yeah.
And then to allocate goodwill 6%, you allocate all.
Okay.
Yes, and 0.2. So yes, I know the 0.8
You say you know what?
because I know the 19.8 is after allocating the impairment, right?
Okay.
Why we allocating 0.2 to PPE?
Okay. That is all. That is a go.
Yeah.
That is a go over that you are talking about.
Yes, but I don't understand why you are allocating 0.2 to PPE.
Okay. How much based on your understanding? How much do you think we should have allocated to the PPE?
I thought we'll prorata it.
Okay. If you prorata it, how much are you going to get? Let me help you. Okay. 20 plus 38. Then 20 divided by the total multiplied by 1.14. How much are you getting? Okay.
Back.
Okay, sir, it's okay, I've gotten it. Thank you.
No, it's not about you have gotten how much did you get after pro-writing it?
Times when you take 0.9, it will be left 1.4.
No, I want to get where you are coming from, the side that you are coming from.
No,
I want to do
I'm not even getting
I want to do 20 over
I'm not
58.
getting
I want to do 20 over 58 times 1.14. Is that not the case that you're talking about? That is the case, isn't it? So I'm getting 0.39.
Yes.
Can you hear me? Okay.
I
So
can hear you.
if you prorata it to be 0.39, isn't it?
Yes.
Okay. Go back to the question.
Okay.
Okay. You are
I'm
with
in
the
the question.
Okay. Stand there. I'm coming.
Yes.
Okay. If you read the question, they said B. Read the B.
The fair values of PP and other assets at 31st December 2021 were 20 and 34, 200 and 600 respectively. The CGU cash flow forecast for the next 5
Forget
years
about
are
that
as
side.
follows.
Forget about that side. What is the fair value?
Yes.
What is the fair value of the PP at the date of the impairment?
The fair value is 20.
How much are we going to incur to sell it? What will be the cost to sell?
200.
So what will be the net realizable value there?
It's
19.8, isn't it? 19.8, isn't it? Can you hear me? Auntie, can you hear me?
Yes, I can hear you, sir. I
Okay.
can hear you. I hear you.
Okay. Someone is also coming. Where did you get the 0.94? The figure fall from heaven, oh, Charlie. All right. So you can see that the net realizable value of the PP is 19.8, isn't it? Okay. So if you want to set the PP now, the amount that you can recover from it is 19.8. But what was the carrying value? What was the carrying value of the PP? 20 million. It was 20 million. Auntie, are you there?
20 million.
Oh, she is gone. Oh, the network is worrying you. Oh, sorry. Sorry, don't
She
worry.
said she's not gone, she's there.
Yeah, the network is worrying high. Or me, it's my network.
Or if she can even type, if she can hear you, she should type.
Okay, so let's count that the impairment on the PP should have been how much? If you want to calculate the impairment on the individual asset, PP should have been 20 million minus the net realizable value of 19.8, isn't it?
Yes, that's it.
Okay. Auntie, I hope you can see the figure here and you can hear me. Okay. So the PP, the impairment on the PP, the individual impairment on PP should have been 0.2. So the PP has impaired by 0.2. So out of the 1.14 over there, the PP, the impairment that should be allocated to the PP should be 0.2 because the net realizable value of the PP is what? 19.8. So in the statement of financial position of the company, the PP should be carried at what? 19.8. It should not be carried at an amount which is lower than the recoverable amount because the recoverable amount of the PP is 19.8. So if the recoverable amount of the PP is 19.8, what was the carrying value? What is the difference? That difference over there represents the impairment relating to the PP. So the impairment should not be 0.39 because if you do that, the asset will now be what? Written below its carrying value. No. Its recoverable amount. No. We only write the impairment to the difference between the carrying value and the recoverable amount. So the 1.14, only 0.2 out of it will be apportioned to what? To the PP, and the remaining of this will be taken to what? To the other assets, because the other assets can contain all of this, which is this minus this will give us 0.94. All right. Okay. So I'm sure, though I can't hear you, but you are okay now. Okay. Let's look at the question number 19. The final one, then we close.
Sir,
Yes, please.
so what could be some of the advice to the directors?
Are they asking you to advise them?
Yes.
The advice is how they should report the figures. So after doing the calculation, you can advise without the calculation. So the advice will be the company, the cash generating unit should be subject to an impairment test where they should determine the net realizable value. They should also, sometimes this advice is the calculation that they will still bring in the question. So you have to do the calculation first. Then the advice will be the cash generating unit should be, or the business unit should be treated as a cash generating unit where impairment test should be carried out on it, because there's an indication that the cash generating unit must be impaired. So you first determine the net realizable value given with the information given. So the net realizable value of the cash generating unit is the total that we have gotten, which is the 53.2. Then you determine the value in use. After the value in use, you take the higher of the two. So the recoverable amount of the assets now of the cash generating unit is 56.86 compared to what? To the carrying value of this. There will be an impairment of 7.14. This impairment should be what? Share like this. Goodwill should take 6 million. PPE should take 0.2 million. Then you explain why you are saying PPE should take 0.2 million. Then this will be taking what? The other assets should take 0.94. So it means that a total of an impairment loss of 7.14 million should be taken to the statement of financial position of the company, whilst the assets of the company should be reduced by what? 7.14, and that will be, should be reduced to what? 56.86. That is the only thing. That is the advice. The advice is just how they should account for the transaction. That is the advice that they mostly talk about. How should they account for this? So you can see that advise the directors of Sando Limited on how the above transactions should be what? Accounted for in each financial statement. So you, after getting the figures, then you tell them the figure that they should send to profit or loss, the figure that they should send to statement of financial position, and even the accounting standard they should use for what? The transaction, and how they should go about it. So still, you do your calculation, and now what? Tell them what they should use those figures for. That is advice. All right. You can still do the calculation and do extract over there and leave the advice. You still get your marks. Benjamin, your hand was up.
Yes, I wanted to know the amount that will be sent to the statement of financial position.
Okay, that will be 56.86, which is the recoverable amount. Okay. Question 19. Question number 19.
This PLC owns a number of printing shops across the country. On 3rd January 2021, the carrying amount of the link's largest printing machine was 65 million. The machine had a remaining useful life of 5 years and a residual value of 7 million using the cost model. Demand for printed books fell during the early quarters during the current year due to increased popularity of e-book readers. As a result, management conducted an impairment review of the printing machine on 30th June 2021. At this date, the printing machine had an estimated selling price of 55 million, and this includes 4 million, which would only be received after an expected reconditioning work has been carried out on the asset, with agent fees being 5% of the appropriate fair price. If the machine is kept in use, it is estimated to generate cash flow in real terms of 20 million a year over its remaining life, which was now estimated to be 3 years, with the original residual value revised to 6 million. The links has the following discount rates: pre-tax 11.9, pre-tax real discount 8.3%, pre-tax discount, nominal discount rate. 10.5 post-tax real discount rate 6.6 required in line with IAS 16, that's PPE, and IAS impairment. Recommend how the links would account for the printing machine in its financial statement for the year ended 31st December 2021. Show appropriate computations where necessary.
Okay. So you can see that the printing machine is going to be impaired. It should be underutilized. It will be there. There will be a redundancy because people are no more buying the hard copy. They are now e-books. So you can see that the introduction of the e-books is going to make the printing machine redundant. So we have to see whether there will be an impairment loss or not. And the question is saying that the company has done that. When was the impairment conducted? At what date?
June 2021.
Okay.
30th June 2020.
So that will be 30th June 2021. Okay. What do we need at this date? We need the recoverable amount. We need the carrying value, isn't it?
Yes.
Yes.
Let's calculate the carrying value. Okay. You can see that you are given a carrying value of the asset at a which date?
As of first
January.
Okay. But we want to know the carrying value for what? For 30th June. It means that we have
30th
used the asset for 6 months, isn't it?
Yes,
okay.
it is.
So that will be 65 million minus 65 over, what is the remaining useful life?
5.
5 years times what? 6 over 12. Am I correct? So we find the depreciation. This is a current.
There's a residual value.
Sorry.
Residual value of 7 million.
Okay, sorry. So this will be 65 minus 7 over 5 times 6 over 12. Am I correct with that?
Yes, that is 5.8.
Okay. So we have 65 million.
9.2.
So I'm going to have 58 divided by 5 times 0.5. I'm getting 5.8. Is that correct?
Yeah, that's correct.
Okay. So we
From
have
my end.
5.8. 5.8. So what will be the carrying value of the asset?
59.2.
59.2 million. I hope you're okay with that. Okay. The 65 was the value at the beginning of the year. We want to, the impairment was conducted at 30th June. It means that the asset has been used for 6 months before. What's the depreciation for that 6 months? Find the depreciation for that 6 months and take it from what? The value at the beginning of the year. So the depreciation will be calculated as the carrying value minus what? The residual value over the remaining useful life, then times what? 6 over 12. We use the asset for only 6 what? 6 months. So let's come to the recoverable amount now. The recoverable amount, you can see that they are giving us information on the net valuable value and also the value in use. Okay, let's come to the issue about the net valuable value. They say at this date, the printing machine had estimated selling price of 555 million, including 4 million, which would only be received after an expected reconditioning work has been carried out on the asset. So the question is, are we willing to carry out the work on the asset?
Yes.
Oh,
We have to, because if we don't do it, we can't sell it.
No. If we don't do it, we can sell it, but we are not going to get a 55 million.
Yeah, so we have to do to get the 55 million.
Okay. So you have to do it to get a 55 million, isn't it?
Yeah.
All right.
Yes, it is.
All right. So what you are going to do is that under fair value measurement, IFRS 13, you see all these things, we are trading in an active market. We are trading in an active market. It means that the participants in the market they have taken notice of what? The 4 million before they agreed on the price. So it means that we have agreed on the price, and the condition is that you have to undertake the reconditioning work so that we can give you 55 million. So the company is going to undertake the reconditioning work because that is what is agreed in the active market. In the active market. So our selling price, our estimated selling price will be 55 million minus what? The agent fee. The agent fee will be what? 0.05 times 55. Are we correct with that? I'm getting 55 minus 2.75. Is that correct?
Yes.
Okay. So what will be the net realizable value? The agent fee is the cost to sell.
Leonard,
Yes, please.
why aren't we taking the reconditioning fee?
We are trading in an active market. Okay. Since we are trading in an active market, it means that all these reconditioning costs has been taken into consideration before we agreed on the selling price. So the agreement was, if we don't do the reconditioning, we are not going to buy the asset.
Yeah, the confusion here for me is that it says that included here is the 4 million, which would only be received after an expected reconditioning work has been carried out on the asset.
Okay. So that is the confusion, isn't it? Okay. If you want to sell assets to me, and I'm saying that the asset, if you are going to sell it to be 55 million, you are going to get 55 million, or you are going to sell it for 55 million. But this 55 million, you can only get a 55 million if you do this and that on the asset. If you do this and that on the asset, it means that we both have agreed that you are going to do that so that you get a 4 million.
You get a 55 million.
You get a 55 million, which is the 51 in addition to the 4. So since we have taken this into consideration before agreeing on the selling price, it means that you have agreed to carry out the reconditioning cost before I will get the asset.
So if I've agreed, the reconditioning cost is a cost to me. And so in calculating my net realizable value, I need to take out every associated cost in making the asset ready for sale. So shouldn't we take out the 4 million?
You have a point. Okay. That is a cost to you.
Yes.
But the reconditioning cost, okay. The question did not say reconditioning cost though. The question did not say reconditioning cost though. Including 4 million, which will only be received after an expected reconditioning work has been carried out on the asset. So that is not a cost. That would be an additional value that would be additional value that you'll be receiving if you carry out the reconditioning cost. I was taking it to be a cost. Okay.
No, it says the 55 includes, so it's not an additional.
It's not an additional cost. It's an additional consideration you'll be receiving if you carry out the work.
No, it's not additional consideration because it says the 55 includes the 4,000.
The 4 million.
The,
4 million.
the 54 is an additional money you'll be receiving to another amount if you don't carry out the reconditioning work. You will not receive the 4 million, isn't it?
This date, the point machine.
If you don't carry out the reconditioning course, you won't receive the 4 million. Is that the case?
So, I mean, looking at it from your angle, what you're saying is that the selling price is 51, but we have included the 4 million.
If you don't carry the reconditioning course, you'll be receiving 51 million. Okay, so the 4 million over there is additional consideration you'll be receiving if you carry out the reconditioning cost, but that does not mean that is the reconditioning cost.
Yeah. If you take it from that angle, it makes sense. But if I take it from the angle where I have to carry out that reconditioning,
so you'll be assuming that the reconditioner cost is the same as the 4 million, isn't it?
Yeah, in my mind, I'm thinking that okay, so whatever cost I'm going to incur is equal to the 4 million, and so
but
I need to take it out.
It can be a situation where the reconditioning cost will still not be equal to the 4 million.
You might be right, because I will carry out a reconditioning cost and put a margin on it before I even sell.
Okay.
Yes.
And that could come to the 55 million.
Okay.
Yeah.
Okay. So the assumption, you can still subtract the 4 million and state your assumption there. But the best assumption over here is that we have already agreed on a reconditioning before setting the price.
Okay.
Because as a rational being, if I'm saying that, or if you do this and this, I'll give you this money, what are you going to do? You are going to do it.
That's 55 million.
So the assumption is that the reconditioning cost or the reconditioning has been factored into the what? Into the selling price. Because if I'm saying that if you take this to this place, I'll give you this amount. But if you take it beyond that place, I'll give you this amount. What are you going to do? You are going to take it beyond that amount, that particular place, and you get the additional money that you'll be getting. All right. So the reconditioning amount has been considered before setting the selling price. And the company will, because Benjamin.
What? Money that you have added to the 55.
Is it?
Like is it?
We can't hear you.
I said, hello.
Yes, we can hear you now.
Yes, because they said including 4 million, which would only be received after an expected refund
has been carried out on the asset. Okay.
So that means the 4 million will be added if the work is good and they will continue the work.
So that would be 59 million in all.
Yes.
Oh, this is okay. This is an English. This is English anyways. But the meaning is that the 4 million is part of the 55 million. That is the meaning. The 4 million is part of the 55 million. That is the meaning, including 4 million.
Including the 55 million is 4 million, which will only be received after an expected reconditioning work has been carried out.
Hello, sir.
Yes, please.
If it is that, then if it is that the 4 million will be cost of completion.
No, please. The question you didn't say is a cost of completion. The question you didn't say is a cost.
Okay.
No.
Okay.
The thing is, I'm telling you that you are a driver. I'm telling you that if under normal circumstances we agree on you carrying 5 people, but I'm saying that if you are able to carry 6 people, I will give you, if you carry the 5 people, I will give you 50 Ghana. But I'm saying that if you are able to carry the 6 people, I will give you 70 Ghana. does it mean that the cost of you carrying the one person is 20 Ghana? Or you carrying the additional person you are going to buy a fuel of what? 20 Ghana to carry the additional person to the same destination that you are going. So in actual sense, what will happen is that you will not be carrying the 5 people because I've given you a cross now. So what you do is that you now carry the 6 people to receive the 70 Ghana.
Yes.
Okay, so the meaning
So
is that the reconditioning cost, we have taken those things into consideration before setting the price. And because it's an additional consideration, the company will be compelled to what? To do it and receive that money. All right. So it's not a cost. The question didn't say it's a cost. If it's a cost, then it will be a cost to sell. The question was not specific about it, is that it's a cost, it's additional cost. No. All right. So what will be the net realizable value that we'll be getting from here?
52.5.
52.25. Okay, let's come to the value in use. Okay, the value in use, we have the years, we have the cash flow, we have the discount factor, then we have the present value. So yes, we have the cash will be received for how many years?
Yes.
Yes.
If the machine is kept in use, it is estimated to generate cash flows in real terms of 20 million a year over its remaining life, which was now estimated to be 3 years. So we are going to receive this for what? 3 years. And that is an
3
annuity.
years.
So we have the cash flow to be 20. Which of the discount rates are we going to use?
Real tax, real discount rate.
Pre-tax what?
Real discount.
Real discount, because the cash flows are in real terms. Okay. So these are the things that they'll be using. So let's find the annuity for 3 years, 8.3. And in the third year, what are we going to receive? In the third year, we'll be receiving something.
6,000 in addition.
We'll be receiving 6 million, which is the
6 million. Sorry.
okay, which is the residual value. At the end of the useful life of 3 years, we are going to sell the asset for 6 million. So that is a cash flow. That is an additional cash flow. Okay. So let's look at the annuity for that. It will be 1 minus 1 plus R exponent negative n divided by R. So this will be 1 minus 1.083 exponent negative 3 over 0.083. So 3 decimal places, what are you getting? Okay,
0.5.
Point what?
2.563.
2.563. 2.563. Let's come to the third year. The discount factor for the third year. 1 plus R exponent. 1 divided by 1 plus R exponent n. What are you going to be getting? That will be 1 over 1. Yeah.
The 2.563 is for the whole 3 years. So.
It is from one.
You are doing it 1 year by year.
No, I'm not doing it year by year. I'm doing the first 3 years for annuity, which is the 20 million. Then in the third year, we are going to receive additional cash flow of 6 million, which is the residual value. Okay. So for the third year, it's a cash flow that we are receiving in the third year. So that will be a lump sum, not an annuity. So that will be 1 over 1.083 exponent 3. What are we getting?
Oh, 0.0.
0.787.
0.887.
0.787.
Okay, let's multiply fast. 20 times 2.563. I'm getting 51.26. And the last one is what? 6 times 0.787. I'm getting 4.72. Let's add 51.26. I'm getting 55.98. Okay. So which figure are we going to pick as a recoverable amount? Is it a net valuable value or the
value
in use? Okay.
The value in use.
Let's find the impairment. The impairment will be 55.98 minus 59.2. What will be the impairment loss?
Point.
3.22.
Yeah, 3.2.
Okay. The question is asking us to what? They say we should. The question is asking us to show the entries for 31 December 2021, isn't it? Okay. The impairment test was carried out on what? 30th June 2021. It means that from this date to the December 2021, we still have additional what? 6 months. So we are going to use the printing machine for 6 months, which we are going to depreciate. But the depreciation will now be based on the what? On the recoverable amount. So that will be 55.98 divided by 3 years, which is the remaining useful life, times, okay, we still have a residual value there. So it will be 55.98 minus 6 million, which is the residual value, over 3 years, times 6 over 12. That will be from July to December. So we still use the asset from July to December. What will be the depreciation that we will be getting?
8.33.
8.33. Okay. Okay. 8.33. Okay. So in the statement of profit or loss, we'll be having a depreciation of what? What will be the depreciation for 2021? The depreciation will be for 2. First will be
8.33 plus
5.8. So we have 5.8, which is the first 6 months, plus 8.33. That will be the total. Then we have impairment loss of, the impairment loss will be 3.22. So what is the depreciation here?
14.13.
14.13. Okay. So this will be for the statement of profit or loss and statement of financial position. Our machine will be shown as 55.98 minus the depreciation 8.33. The recommend is just the calculation. Recommend how this will be done is the calculation. The advice is in calculation. If you look at how they answer the question, you still have to do the calculation before you give the recommendation or the advice. Okay. Basically, this is all about this question. It's 8:58, and I can't do the 5 again. So the 5, I will send it to next week by this time. But Saturday, we are doing 2 standards. It will be maybe provision and government grants. I don't know. Maybe I will do borrowing costs and government grants. I don't know. Okay.
Okay.
Yeah.
Yeah. Can you please drop the notes on the page? Okay.
Which one?
This one.
Oh, is there?
No, the notes. This note you're using.
Hello, Linus.
Yes, please.
You mean the
I think
whiteboard?
there's corporate
Sorry, the
asset
whiteboard. I mean.
aspect.
You said what?
I said corporate asset. You've not done that.
Leave
It's
it.
part of the note.
Leave it. It's for you people to read.
Okay.
It's, it's,
Okay.
it's not part of the exam. You will not see it in the exam. But since maybe if I have time, I'll come and tell you. It's 8:59, and I cannot take that already. But I can explain that. You see, mostly what happened is that you can purchase a subsidiary. So you purchase two subsidiaries, which their operations cannot be differentiated. So since their operations cannot be differentiated, what you do is that you cannot even differentiate their net asset and also their goodwill, or you purchase a subsidiary which is having two departments, or you purchase a subsidiary which is having two sections, two divisions. So in this case, you cannot separate the two divisions. So what we do is that you are coming to put the net asset for them together. So if you take the net asset together, it means that you are going to calculate the goodwill for the two divisions as if they are one entity. So it means that the goodwill that you'll be getting over there will be the goodwill for the division A and also the division B. So how do you go about that? You cannot share the goodwill among the two divisions. So whenever there is an impairment, you have to conduct the impairment and ask yourself whether the consolidated goodwill or the corporate goodwill has impaired or not. So the corporate asset comes in when the goodwill or the net asset of maybe an entity that the company is buying cannot be separated. You purchase a subsidiary and the subsidiary is having two divisions. How do you differentiate them? How do you differentiate their net assets? How do you know that the goodwill that you are calculating or the goodwill that you are getting is for division A or division B? So how do we go about that? So we put the goodwill over there as a whole goodwill for the two divisions. So anytime there is an impairment, the impairment should first be taken to the what? To the goodwill, which is a corporate asset. So that is why we say the corporate asset. Okay. You will never see that in the exam. I don't think so. All right. Okay. So that is all. If we don't have any further questions, I would like to end here, and we will meet on Saturday. All right.